In this example, we'll be going over review exercises 6-8 and 6-9. Here we're going to be talking about the journal entries that need to be recorded when a company assigns their accounts receivable. A company can assign their accounts receivable in order to secure a loan. So what happens is they get a loan from a company. The company that they're getting the loan from decides which accounts receivable that they're willing to accept as being assigned to them. Meaning, when the company collects money from those specific accounts receivable, that money has to be used to pay off the loan that they have. So for the example, in review exercise 6-8, it tells us that on December 1st of the current year, Jordan Inc. assigns $125,000 of its accounts receivable to McLaughlin Company for the cash. McLaughlin Company is going to charge a $750 service fee and advances 85% of Jordan's accounts receivable and charges an annual interest rate of 9% on any outstanding loan balance. And we need to prepare our journal entries for securing this loan. So on December 1st, we actually need two journal entries. The first journal entry is going to record the cash that we're receiving from this loan. So we are receiving cash. We are assigning $125,000 of our accounts receivable. The company that we're assigning it to is only giving us 85% of that value. The reason for that is there is a possibility that we will not collect all of that. We could have some bad debt. And we also have to pay a $750 fee. So that means in total, we are receiving $105,500 in a loan. We also have that $750 fee that we're being charged, and that is an expense for us. So we have an assignment service charge expense of $750. We have to pay this back. So our credit is going to be to notes payable, which again, the $125,000 is what we assigned, but we are only getting 85% of that, which means our notes payable is for $106,250. We need a second journal entry on December 1st because we need to classify these specific accounts receivable as being assigned. We cannot use the money for anything else except to pay off that note payable. So we say our accounts receivable that have been assigned for $125,000, and it comes out of our normal accounts receivable pool here. Now we go back to review exercise 6-9, and it tells us that using the information from the previous exercise, that on December 31st, Jordan Company received $50,000 on assigned accounts, and we need to prepare Jordan's journal entries to record the cash receipt and the payment to McLaughlin. So again, we're going to need two journal entries on December 31st. The first is that we have to record that we are actually collecting cash. So we are receiving $50,000 cash, and we are collecting it based on those accounts receivable that have been assigned of $50,000. We now need to use that $50,000 to pay off our notes payable, or a portion of our notes payable. So that full $50,000. We also owe interest expense at the time that we make a payment. And they had told us in the previous exercise, review exercise 6-8, that our interest rate was 9% on any outstanding balance. Well, since we hadn't made a payment yet, our outstanding balance was $106,250. Our interest rate is 9%, but it's only been 1 month that we've had this loan. So we're not going to pay the full 9% because that's an annual rate. We are going to pay 1/12 of that amount, which comes out to $797 in interest. And we are paying off that portion of our loan in cash.